There's a few different things along with high valuations that could absolutely derail this market. And so if you've had an opportunity to really participate in some of these gains over the last few years, these are historical gains and I wouldn't take them for granted. I'd be looking to diversify them in something a little bit safe, maybe build some cash, and there's multiple ways we can do this. Well, Happy New Year, everybody. Welcome into 2025. And in this video, I want to talk about an investment strategy that I'm going to be taking this year, and I'm going to be sharing it with you guys, kind of keeping you updated on exactly what I'm doing and the opportunities that I'm seeing. Now, if we take a step back, we've had multiple years of outrageous gains, historical gains to be quite honest with you, which is now leaving us in an interesting area. As political tensions now pick up and we have a new president taking office over the next few weeks, we are starting to see volatility tick up and valuations creep at historical levels. Now, with all that being said, I want to talk about opportunities and the investment strategy that I'm personally taking for this year. I definitely think this is a good opportunity to look at your portfolio, take some of these outrageous gains and play with the house's money, because I do think that we are going to have a correction and or pullback. I think the biggest opportunities are possibly going to come at the end of this year, but let's dive into today's video. Now, the first thing I want to point out is the S&P 500 Shiller Cape ratio is sitting at 37.5. Now, as we see, it obviously can go higher. In the dot-com bust, we can see that it got as high as about 44.2 times. If you're not familiar with the S&P 500 Shiller Cape ratio, it's taking the price of the S&P 500 divided by the 10-year average of earnings and adjusted for inflation. So when we take all of that into the equation, we really get an understanding of the valuation of the market. And we could count 3 times that we've hit these levels, 1999 being 1, 2021 being 2, and currently we are pushing as of 2025 to being the 3rd time in history that we've really hit these types of levels. And when we think about how high we're adjusting for all of this, to me, this is really related to government spending, it's related to stimulus, and it's related to the amount of money that's been dumped on the market. Roughly 60% of money that's circulated through our economy has come in the last 10 years. And if we take a look at this, the last 10 years have led us to pretty ridiculous valuations. Now, if we look at the current PE ratio of the S&P 500 sitting at 27.5 times, was pushing nearly 28 times towards the highs of this market. We're probably looking at 23, 24 times forward earnings. This is historically high. In a healthy market, we want to be looking anywhere between 17 to possibly 20 times earnings. And on a forward basis, maybe looking at 15, 16 times earnings. So from almost every metric we can look at here, we are looking at historically high valuations. Now, if we look at the market overall, it's really about 10 to 20% of names that are trading at historical valuations, which means that there is some opportunities underneath if you're willing to do some digging. But the majority of the money is flowing to passive indexes, and that's why we're seeing bloated outperformances from your higher valuated stocks, which is now going to lead us to the 10-year treasury. When we start comparing a 10-year treasury pushing over 4.6% and an S&P 500 trading over 25 times, we're really looking at equal valuations here. Now, if we get a 10-year treasury pushing over 5%, that's basically giving us a 20 PE ratio with a risk premium attached to that. Because when we start dealing with these higher valuations and a higher 10-year treasury, we can say that there is competition for money. Not only is there competition for money, but companies that are carrying debt or rely on the debt markets, whether that's your small cap companies or companies that are unprofitable or companies that are just carrying a tremendous amount of debt that needs to be refinanced, much like your REITs, we still have to look at this 10-year treasury as being a headwind to those companies. Not talking about all the political tension that could be coming down the way with tariffs. We've seen multiple terrorist attacks recently. These are historical gains and I wouldn't take them for granted. I'd be looking to diversify them in something a little bit safe, maybe build some cash, and there's multiple ways we can do this. Now, one of my favorite ways to do this is actually writing calls against your positions. Now, the thing I want to point out here is the S&P 500 did just hit the 100-day moving average and bounce nicely off of that. So I do want to point this out. Now, the one thing we want to pay attention to, is this a downtrend that's formulating and are we breaking down on the S&P 500? Or is this actually going to be a breakout and we're going to test new highs? So there are 2 options on the table here where we could be looking at bouncing off this 100-day moving average. Buy the dip crowd could still be alive and well, telling us this with the double dip. And now, are we going to hit new highs? Or is this a new downtrend that could be formulating? So that's something we want to keep an eye on. As of right now, really hard to tell. I am seeing bullish divergences underneath, which is telling me that we could see a little bit of a rally here into middle of January. But when we talk about an S&P 500 that has ripped up here, and let's just say that you owned a couple hundred shares of the S&P 500 and you want to write some calls against it. Well, we can see here that the recent high was 607 and it's currently trading at 591. So for me personally, for the S&P 500, I'd probably go a month or two out, basically looking at mid-February to possibly start writing some calls against my position. And I'd be looking just around that 600 mark. This would give me about another 2% rally. It tends to be an area that the market may have a hard time breaking back out of. Let's just say I want to sell 2 contracts. Maybe I have 500 shares of the S&P 500, but I only want to sell about 2 of them or half my position at 600 on February 14th with a $600 strike price. Now, the market's not live right now, but you guys can get the idea here. So if I were to do that, I would collect $1,554 in premium, and my break even would be 607.77, which would be pretty much the recent high in this market. Now, of course, this is not financial advice. I always recommend talking to a professional before making any types of moves, but this is just where my mind is personally going. And I'm gonna take you through what my strategy is most likely going to be going forward if we start seeing 5% on the 10-year treasury. Now, there's a couple instruments here you can use. You can use ZROZ, TLT, but I'm specifically looking at the longer end of the yield curve here. And so BLV is the Vanguard version for long-term bonds. You can see here it has nearly a 4.4% yield with an expense ratio that is very, very reasonable when you compare them to their peers. And so that's why I'm looking at the Vanguard. Vanguard does a really good job of keeping expense ratios really low. So this is a good one to possibly use. Now, the thing I want to point out is if we go over the last 5 years, we can see here that the price of the bonds have absolutely tanked, which means the bond market has had a very bullish move over the last few years. Yields are going up, which means the price of these bonds have come down. So a few different ways I would play this. If we start seeing the long end of the yield curve start pushing 5%, then I definitely think locking up something like this makes a tremendous amount of sense. I'm not saying you put a ton of money in it, but it gives you some safety for any sort of recession or if yields absolutely collapse. If something crazy happens and there's a flock to safety, whether it's a war breaking out, whether it's a recession hitting, we could see these types of bonds absolutely skyrocket in price. For someone who doesn't understand the options thread and doesn't understand how to position themselves, then I just recommend buying 10-year paper. But for somebody who's a little bit more active and wants to add additional yield, you can now write calls against these positions. So if we do see a 5% yield start approaching on something like the Vanguard long-term bond, I could start writing calls against this position and create 7 to possibly 12% annually. Now, we are still in a very bullish move when it comes to yields. So who knows, maybe yields can go to 6-7%, which means the value of these would actually go a lot lower and you would be underwater. So you have to be very, very careful, have to understand what you're doing and understand what the objective is of your portfolio. So going forward, I'm actually going to show you guys how I'm writing calls against certain positions, or I'm writing cash secured puts against certain positions to build in, collect the premium. But specifically, I'm looking for very safe, low multiple type stocks that pay dividends where I can create that extra revenue, low beta, which means that there's not a lot of price action with them. And also what I'm finding pretty interesting here is long-term corporate debt's actually getting in a pretty interesting area as well. Once again, this is a Vanguard product. Where the current price is on this Vanguard long-term corporate bond index, we can see it's paying about 4.86%. Very, very low expense ratio once again. And I believe this pays out monthly. So I would actually be writing monthly calls on this along with collecting that monthly dividend. And we can see here that the price action is very similar to the bond market, where yields are going up, but the price of those bonds are actually coming down. It's always an inverse correlation. So not only do you have an opportunity to collect nearly 5%, and I would wait for this to dip back down to the lows of around 64 and getting over a 5% yield with expenses included. From there, I think the risk versus reward makes a lot of sense, especially when we're comparing it to an S&P 500 trading at historical valuations. And you also have the upside of the bond value going up and also creating that yield with writing calls against the position. So this is the strategy that I'm personally looking to implement this year. As valuations creep up higher and higher and higher, I want to create some safe high yield in my account along with having some sort of insurance on a downturn. And so having exposure to both of these things, if yields collapse, both of these should actually outperform the market. Now, of course, there is scenarios where both yields could go up and stock market could come down, and that's kind of what I've been waiting to play out before I actually build into these positions. So as always, guys, this is just me doing a dive into what I'm personally thinking, what I'm personally seeing. And as always, appreciate everybody's time. We will see you all in the next one.